I'm Rick Albert, and welcome to The Key to the City of Angels, the podcast where we unlock the secrets of Los Angeles real estate. With over 300 real estate deals under my belt, I've seen it all, from house hacking strategies that build wealth to helping clients close multi-million-dollar deals in one of the most competitive markets in the world. Every week, I'll bring you expert insights, market trends, and inspiring success stories to help you navigate the LA real estate scene. Whether you're a first-time buyer, an investor, or just curious about what it takes to thrive in the City of Angels, this podcast is your guide to making smarter decisions and achieving your goals. So grab your keys. It's time to unlock your path to prosperity in Los Angeles real estate. Welcome, everyone, to another episode of the Keys to the City of Angels. I'm your host, Rick Albert. Today, I have the world-famous Joe Parisi of R8. It's no longer guaranteed rate. Is that correct?
That's correct.
Yeah.
You're too kind with your introduction.
I've known Joe for a long time. He's actually known my broker for 40 plus years?
Yes.
Something like that?
That dates me a lot. So.
Oh, I'm sorry. He's only 25. I swear.
Yeah, there you
swear. I don't know if there's anything else you want to add. Otherwise, we can kind of jump right into it.
I've been working with Paul for my entire career. So it's been 36 years. So
wow.
I've been in the business, started with him. I was as green as can be, and he was the best mentor I could have. He really taught so much. So yeah, I'm ready.
Perfect. So obviously the topic's going to be mortgages. A lot of expectations were not met last year. So what exactly happened last year with rates in 2024?
You're right. It was a complete surprise. We've been waiting now for rates to come down for over 2 years. Everybody was predicting they're coming down. And then at the beginning of last year, they actually started to, because mortgage rates, unlike what the Federal Reserve does with their rates, there's two different rates. The Fed controls short-term rates. In fact, their discount rate is literally an overnight rate that banks charge each other. So they control that. It'll immediately affect short-term loans like car loans or home equity lines of credit. You see here the Fed's dropping, those will drop. On the flip side is the 30-year mortgage, which is a long-term rate. That is influenced more by inflation and what the economy is doing. So inflation is the enemy of mortgage rates. When inflation goes up, you're going to see interest rates go up. When it goes down. So at the beginning of 2024, we were seeing some really nice favorable numbers on inflation coming down. So they started to trickle down. And that's when that gave the Fed the license to make their first cut in 4 years. So they cut, the first cut was pretty dramatic, which was a 50 basis point cut, which is 0.5%. Normally it's only 0.25%. So they went with a full half, kind of shocked the financial world that they went that much. And then almost immediate, like within the next few days, we started seeing the numbers on inflation and the economy reverse. So inflation, although it was coming down, it hit like a plateau and kind of just stubbornly stayed steady. So we were seeing that the rates on inflation were not coming down. And then on top of that, which is a factor of the economy as well, is the jobs numbers, the employment report. It comes out every month. And what happened after that Fed rate cut is we started to see huge numbers on the jobs numbers. Every month they predict what they expect, and it was like, we're going to get 150,000 jobs this month, and it came in at 250. So the numbers were starting to show the economy is booming and potentially inflation might go up. So that's where the tide turned, and we started to see rates go up at the end of the year. So hitting a peak, probably, I'm guessing, you think it was around October, and remained stubbornly there for a while.
So basically, as society does better, rates go up.
Right. It's
like, oh, I have a job. Great. I can buy a house. Just kidding.
If you want lower interest rates, you got to hope for a bad economy.
It's why I talk to people about. They're like, oh, will rates ever go down to the 2s or 3s? I'm like, if it goes down that low again, we have far bigger problems.
Right. That's exactly it. It took the pandemic to bring them that
Hmm.
low. So, you don't want that again. But yeah,
No.
to get down there again, we'd have to have a drastic catastrophe happen.
Yeah. So then what's going on today in 2025?
Well, what we're seeing now, and this is actually relevant to today and yesterday, is that the jobs numbers that came out were decent, but now we're starting to see some of those job numbers in the past that brought the rates up, they issue revisions. And those job numbers, when the revisions were done, they showed that, hey, they didn't quite increase that much. And the reason being is that the jobs numbers, they use imputed data, which means they're not actually real. I mean, one example is one of the factors is they'll call up homeowners and ask them, how much could you rent your home out today if you were to rent it? And the homeowner
Hmm.
answers the question. They rely on that data to go into the report. So it's not completely accurate. And then also part of that is in the inflation numbers is the shelter component, which is that exact thing when they call and they ask, what could you rent your home out for? And that's a delayed part of those job numbers. So what we're seeing
Hmm.
now, and hopefully it won't reverse again, is that we're seeing the numbers on employment really weren't as strong as they were. And the job openings figures, which is another number that's released monthly, are getting lower and lower. So
Hmm.
in the last couple of days, because of those numbers that have come out, we're seeing a little bit of a reprieve, and they've come down about 0.25% over the past 2 days.
Interesting. So but what if like there's aren't as many job openings because but then it's not like people actually need to look for work. Like, could that actually be a good sign in some ways? It means like people are working. There's just no reason for job openings, but people aren't necessarily looking for jobs.
Yeah, it could.
It'd be
The other
rare, but
the data that comes out with companies that are closing down, you've seen in all the bankruptcies. Latest one I saw in the paper today was the craft company, I think it's called Jones. They declared bankruptcy today. So, there's signs that we're slowing down, which is, again, like to your point, is what's going to bring rates down. The other positive outlook is that there's a spread between the treasury rates and mortgage rates. If you wanted to place your money in an investment, the US Treasury is the safest investment you could put it in. So
mhm.
it's guaranteed. Mortgages are a little more risky because you have the risk of default if somebody goes into foreclosure and also the runoff. So if you invest in a mortgage and somebody refinances and pays it off, you don't have that investment anymore. So there's a
Hmm.
spread. And that spread is traditionally around 2%. Now we're close to 3. And that's because of just the uncertainty that we've talked about now over the past year. With the Feds starting to slow down, and we kind of see a path on where they might go, which is from a year ago, they were predicting 10 Fed rate cuts. Now
Yeah, I
we're looking
remember
at
that.
this year, one, maybe two. So that uncertainty will hopefully bring that spread down. So we could see, treasury rates in general stay the same, but mortgages come down just because of that spread. It'll be closer, and that'll bring the mortgage rates down even if treasuries don't come down.
And is that also partially because people are less likely to refinance? So like it's almost like a safer bet because people are locking into their loans longer than they used to.
Right, exactly right.
Okay.
Yeah, yeah, you don't have that fear as an investor that this loan will be paid off soon.
I mean, my first place I bought, let's see, I bought it, we had closed in like September. I had refinanced that following January, and I think I refinanced again that following March. This is like
Yeah,
2015, 2016. I
yeah.
was like, oh, the rates dropped. Okay, the numbers actually make sense to do it.
We saw that during the pandemic. We had, people refinanced into 4%, and then they refinanced into 3, and then some down to 2. So some did 3 refinances in 1 year. So,
Yeah. Well, you did my refinance.
yeah.
You were, I was one of them.
Oh,
And
that's
yeah,
true.
you're
Yep.
right. We had done two refinances. We did one that was an FHA streamlined refinance, which for those who don't know, it's basically FHA loan to FHA loan, but they don't really care about appraisal or anything like that. Yeah, which worked for us because we had an ADU and I knew there was no ADU comps. So I was like, I don't want to take the risk of doing an appraisal. And then when I spoke to your team, we're like, okay, let's do it again. And I remember I was working with one of the people that worked under you, and he's like, just hold off real quick before we lock in the rate. I'm like, okay. And then all of a sudden he's like, you need to lock it. It's like 2.875. I'm like, okay. And it's like, here we are. And we're not moving, right? We're not
Right,
going to refinance that. It just
right,
doesn't make sense.
right, right. No, I know
Yeah.
it's nobody can predict the future,
Right.
but I think we, as an industry, both real estate and home loans, need to educate the public on the fact that we have to have a change in mindset where, these rates, even at the low sixes, or not low sixes, I'm sorry, high sixes right now where they're at, are not bad. I mean, if you look at the history of interest rates, and if you want, I could share my screen to show you a little graph on that. Let's see if I can get it up here.
There we go. Now it's coming up.
Okay. So this is the history of mortgage rates over the last 30 years. Here's where we're at now. And you can see that we're not doing too bad compared to historically where rates have been. The average over the past 30 years is 6.77%. So we're right
Uh-huh.
there on the average.
Hmm.
And you can see what happens. The gray lines here, they
Hmm.
are recessions. So you can see after a recession, like we said, you kind of want to wish for the worst. Recession rates go down. Recession rates go down. The last one we had was COVID, which is the thin one. So
Hmm.
to my point, historically we're not doing that bad, and if people wait, they might be waiting for a long time. I mean, hopefully they do come down, but I think we have to settle into the fact that we might be in the sixes here for a while.
Yeah, what I've been talking to clients about, potential clients, is like buy what you feel comfortable with, buy what you can afford today. If rates go down, great, you refinance. If they go up, then you just don't change. Don't buy with the hope that something's going to change.
Right, right. The kind of the corny saying we have in the business is marry the house, date the rate.
Right.
So,
Exactly.
and if you buy today, you're gonna be a participant in equity. So
Hmm.
we're still seeing prices go up even with these rates. And if you were to wait for rates to come down, one, you're going to miss out on months of appreciation, and two, you're going to be facing a lot more competition when you're putting in offers. When rates come down, there's going to be everybody coming out of the woodwork, and you
Yeah.
won't be able to, compete like you would in this kind of a market where it's not that, you're not facing 20 offers like we did back in the pandemic.
And if prices go up, then your payments are the same regardless. Like it's one
Good
way or
point.
another.
That's a great point. As a renter, your rent's going up every year, you know?
Yeah.
So as a homeowner, you've locked in your payment.
Right.
Never going to go
It,
up.
right. So what I don't know if you can comment is like as a mortgage industry as a whole, because there's been so much change so fast. How are they reacting to the rates not moving how they expected and it being high for the last 15 years?
Right. We have to get a little creative.
Hmm.
One of the programs that has worked out really well is interest rate buydowns, which
Hmm.
is where you negotiate a seller rather than have them reduce the price, have them pay for an interest rate buy down for the buyer. And
Yeah.
it's a win situation. So instead of the seller reducing a price by say 50,000, they could offer the buyer the same monthly payment for say 25,000, half of that, by paying for the buyer's interest rate buy down. So the buyer gets the lower payment just as if it was a price reduction, but the seller doesn't have to cut as much. So that's
Hmm.
been successful. A lot of programs now for first-time home buyers. We're probably, in my 30 years, it's probably the best as far as loan programs available for first-time home buyers I've ever seen. I mean,
Hmm.
you could get in with zero down. It's not a myth. There's a lot that the 3% down that many lenders offer. So we're seeing that the challenge obviously is the affordability, because as prices have gone up and the rates have gone up, the monthly payments are going up as well. And then the other challenge we have is what's called the lock-in effect, and that's reducing the supply of homes coming on the market. So, people that have that 2 to 3% rate, like
Yeah.
you don't want to sell and buy if you're going into a 6% rate. So
Yeah.
that
Well, I'm
should
hearing a lot of HELOCs. And my hunch is that people are pulling out the HELOCs because let's say they have a 3 bedroom house, it'll be cheaper to do a HELOC and just add a fourth bedroom than it would be to go buy a 4 bedroom house today.
Absolutely. Yeah. HELOCs right now, the volume just has surged on them. For that
Yeah.
reason that you have that 3% rate, you don't want to refinance, you pull the equity out. And that brings me back to the affordability subject, which is what one thing we're seeing a lot of is family help. So we're seeing the mom and dad taking out the equity line to help with the down payment as a gift for the buyer. We're seeing a lot of co-signing, so mom and dad co-signing, because there's a huge amount of equity. I think, but yeah, I was looking it up. U.S. equity in home ownership is a $37 trillion amount. So there's a ton of
That's quite a
equity.
HELOC. I don't even go
Pardon
that
me?
high. That's quite a
Yeah.
HELOC.
So instead of waiting, when they pass and die and give it to their kids, a lot of parents are saying, let's give it to them now. We'll give them the equity we have in the house through a HELOC. And that helps lower the payments. So that addresses that affordability problem.
Yeah, I remember a few years ago when, homes were flying off the shelves, I was seeing like a lot of parents were buying the houses cash for their kids. And then they'll just do the cash out refinance after the fact
Right.
and get their money back. But at least it got them competitive.
Exactly. Yeah. So yeah, if they have the opportunity for that's great because they can
Yeah.
refinance if they want to put financing on it. If it's within a 6 month period, they'll get the same rate as they would on a purchase.
Oh,
So
interesting.
it's called
Okay.
delayed. We call it delayed financing.
Okay. That's interesting. Are you foreseeing, is there any talks of like tighter regulations going forward or anything that's going to become more of a challenge in the mortgage
We're
industry?
not.
Okay.
We're actually seeing the opposite. What's been a boom along with the HELOCs is what's called non-qualified mortgages.
Okay.
And what that means is the lenders that are coming in are private lenders that don't have to adhere to the strict guidelines of, say, Fannie Mae or Freddie Mac, the government agencies.
Hmm.
So they'll allow for much easier qualifying. One, for example, they'll go up to a 55% debt to income ratio. So we're seeing that the market's still opening up with less restrictions and more availability of product that can help out a buyer.
Are you seeing more like advising clients like, look, you got to pay off the car in order to qualify. Like, whereas before, because rates were so low, it's like you were fine. It was practically free money. Now with the rates higher, people have to now change how they manage their finances. Are you having those
Absolutely.
conversations?
Absolutely. That's a great point. Yeah. And I would say if I had to put a number on it, probably, 1 out of 5, 1 out of 4
Hmm.
buyers that I work with, they're going to pay off debt or pay off a car to help them qualify.
Interesting.
You can pay off a car loan and it could increase your qualifying by 50,000 in a purchase price. So
Hmm.
it's a huge difference. And then we're also seeing along those lines on cash out refinances. If you have that 4% rate and you say, why would I refinance into the mid sixes? It makes sense if you're paying, a car loan or 2 car loans in most cases, credit card debt. You're paying 1,500 a month out in those other debts. When you combine that with the monthly mortgage payment, it makes sense because your total outgo will still be reduced, even though you're going into a higher interest rate.
Right.
Potentially get a better tax deduction too.
That's a good point. Out of curiosity, totally off. Let's say you want to do a cash out refinance because you want to pay off debts, but your debt to income's too high because of the debts. Is there a kind of like an exception of like, well, no, we're going to use that money to pay off those debts. Now we're good.
Yes. So we
Okay.
don't count those debts in the qualifying in the debt to income ratios if it's being
Hmm.
paid off. And it's pretty simple because it's paid off through escrow. So
So they
the
don't have a choice.
at the closing, yeah, so we know we want to make sure it's paid
Right.
off. We don't want to just take their word for it. So it's paid off through the closing, and then we eliminate those debts in qualifying with the debt to income ratio.
Okay, which makes sense. I mean, I
Yeah,
guess there's always the risk of the credit card debt. You pay off the credit card debt, but then they can rack up the credit card again. But
you
that's
know,
just that can happen anyways. They can get a new car loan after the fact.
yeah, years ago, most lenders would have you close out the credit card.
That was going to be my next question. Yeah.
Now they don't. So it's kind of amazing. You can pay off 50,000 in credit card debt and you could go out and pull it out the next day. So
Yeah, it's was to become a accredited investor, you had to have a net worth of at least 1 million, but you can't include your primary residence. Like, then fine, I'm gonna go rent a house,
yeah,
move there, and now I'm, a qualifier because I don't live in that other house, and that house has equity just for me to move right back in after the fact or whatever it might be.
no, I know. Unfortunately, I have a couple clients that are in that mode where we refinance to pay off credit cards and then a year later we're doing it again.
Oh, but
Yeah.
like, is that an indication? Because like, there's all these reports like, oh, foreclosures are up, and then I have to explain to people they're only up because people in 2019 and 2020 who should have been foreclosed on are now starting to get foreclosed on. But is what you're saying, if you are seeing that, is that indicative of a bigger problem potentially later on?
It is. The one factor that makes us able to do that or lets the industry do that is equity. You've got to have the equity. So
Okay.
someone, they refinance into a $700,000 loan, they refinance into a 900,000. If the property is worth 1.5, they're not going to go into foreclosure. If they were
Because they're better off selling.
underwater and they just totally lost it and they can't make payments anymore, they're going to sell. They're not going to let it go
Right.
fall and foreclose. So it's
Right.
equity, once again, the equity that's been established over the past few years that makes it a safe investment for a lender.
That makes sense. Because when I did my HELOC 2022, they would go up to 90%. And so I
Right.
did 90% LTV, and then I reached back out. It was like a local credit union. They're like, yeah, no, we don't do that anymore.
It's 80. Yeah.
Like they're like, no, we don't touch that.
Yeah.
So okay, that's interesting. What have you been seeing, here in LA or, I guess California, but like what are investors doing? Because the rates are always higher and the cost of getting the loan is so much higher.
Well, we're actually seeing that spread between the primary residence rate and non-owner occupied rates lessen. It's
Hmm.
shrinking. And that goes back to the private lenders, the non-qualified mortgage lenders. With a low loan to value, so if somebody's say putting 30,
Hmm.
40% down, you could get a rate that's pretty darn close to primary residence rates now, like maybe
Hmm.
only a quarter difference. So we're still seeing investors buying properties, maybe not as much as when we had the
Sure.
rates really low, but they're doing it now. They don't, like we talked about before, competition. They're not, going up against 20 buyers that are putting in offers, and they think there's an opportunity there.
Right. Yeah, I was talking to a flipper recently because I had a property. I was like, well, this could be flipped. The margins are tight, but you can make it work. He's like, but I get financing. And that blows it out of the water. And that's part of the problem. And I'm looking at buying properties, and it's just like the numbers are either super tight to where like one mistake I make and it's like done for. Unless to your point, you put more money down, that just creates a better spread.
Yeah, and that's what we're seeing is to make sense, to have at
Yeah.
least a break even or cash flow that's on the property. You've got to put a pretty good chunk down to make it work.
Yeah.
And that's just
Yeah.
because of prices that have gone up, up and up.
Right. Yeah, and there's even on the multifamily side, especially here in LA, because there's rent control, so you have a lot of tenants paying grossly below market rate. So it's like, I mean, I'm literally seeing, a two-bedroom that's being rented out for $400 to $800 a month.
Yeah.
And it's like, yeah, you're not getting anywhere near your price.
Yeah. Yeah. No, I hear you. I have one on my street here, a 4 unit
Hmm.
that they're asking way too much. And it's vacant. It's just,
Yeah. Yeah, even the vacancy. Because, one of the challenges I learned last year, I bought a property where one unit was vacant and then was going to become vacant. This was out of state. And, it's just been so challenging to get it rented. We're just seeing a major slowdown in multiple, like across the board. So it's like, yeah, if the rents were at market rate, I probably would consider paying a premium for it if I knew that there was already tenants in place.
right. Understood.
Yeah, because the
Yeah.
vacancy is rough.
Yeah, and that's back to the point of the numbers that are coming on inflation and the shelter numbers. I think they're going to come down even further
Yeah.
to that point that, you're having a tough time finding the renters.
Yeah. So going into this year, we can't predict rates because everyone who has predicted has been wrong. So, I mean, we try, we do our best. But is there anything in particular that you think is going to happen? And again, we know this is all speculative. We're not going to hold you to it, or maybe we will. Who knows? Some people have grudges. But I don't know, what do you think is going to be going on? Do you think there's going to be more buyers, less refinances?
I think there will be more buyers, yes.
Yeah.
And of course, obviously it's tied to interest rates. But I think it may be a little Pollyanna, but I think with the revisions we're going to see in the jobs numbers, with that lagging shelter component coming in, and actually the Fed's pausing on their rate cuts, it's going to help mortgage rates.
Hmm.
So, we have stability, and like I said, that spread between mortgage rates and the treasuries is going to come down. I think there's a lot of pent-up demand, people that are just holding because they think rates are too high. So I think if we get even a trickle of a bit of a lower rate, like, there's some predictions, and like you said, nobody can see the future and they're usually wrong. But there's thoughts that we could get into the high fives this year, which definitely
It'd be
will
a game changer.
be a game changer for buyers and then open up the doors.
Yeah. And even for a lot of sellers, because a lot of people I've talked to, so I think one segment of the buying population are the people who bought in like 2022, where the rates are about what they are today, maybe a little bit less, but for them to make that move isn't going to be it's not going to hurt as much
Right.
because they're just so, they're already used to it.
Exactly. They have that mindset.
Right.
Here's
But
where we're at.
yeah, and I think that would I sell my house even with a low? Yeah, for the right price. It's just a matter of what I would do with the money.
Right.
Yeah, I've talked to people who have investment properties and we're like, oh, should you sell? Should you not sell? Like, well, I have a low interest rate. I'm like, who cares? What do the numbers look like? Are you getting
Right.
enough rent? Like, I don't care if I have a low interest rate and I'm losing, but if I'm losing money, I'm losing money. It doesn't matter what the interest rate is.
That's right. It's
Yeah.
not the rate, it's the monthly payment and the rent. Yeah.
Right. Exactly. So, no, I agree. I think there is actually going to be more buyers coming out, especially here in, Los Angeles. We generally have higher paying jobs, right? And,
Right.
unfortunately, we do have the fires. A lot of it was in Pacific Palisades. I would say most, if not all of them, are high income earners to be able to afford the
Oh yeah.
Palisades,
Oh yeah.
So I think the average price there at one point was, about 3.5, maybe 4 mil. So, you know, they're gonna be renting for a short period of time and then they're either gonna move back home once the house is built or they're gonna go buy something else.
Right. Yeah. It's definitely, although it's tragic, it's going to spur some activity
Yeah.
because those people that were horribly, put out of their homes, they've got to do something, buy a new home or
Yeah.
rebuild. So it's going to create activity for sure.
Yeah. And it will be interesting to see. I think that, I was talking to an insurance agent, and then after the call, after we did the recording, we had like an off topic of like, okay, if we owned a property and it was paid off, would we rebuild? And that's always like the question because at that point it makes
Right.
sense to sell. But for a lot of people, they have a mortgage on it. They can't sell it because the land value is less than the mortgage.
Right. No, that's a good question. Yeah. Would you or not?
Uh, and my answer was it depends if I was already intending on moving. I think if I was already intending on moving, I probably would just sell and move on. Why would I go through the headache of construction
And the time. I
and
mean,
the time?
you're
Chances
talking
are I
two
wouldn't be
to
able to
three
rebuild the
years.
same house. Yeah, I mean, I spoke to a contractor who's built in the Palisades. He said, the challenge with a lot of his investors is time with the city to get the plans approved.
Right. Right.
They're saying they're going to expedite it, but I don't know. Is that 6 months versus 5 months? I don't know what that looks
Yeah,
like.
I heard the governor, improving and removing some of the restrictions for the fire areas. So hopefully that'll help. But still, it's still
Yeah,
time.
yeah, I agree. I
And
agree.
you're going to have, you've got, supply and demand thing. You've got a certain amount of builders, and how are they going to build? How many thousand homes burn? Uh,
Yeah.
they're going to be in such high demand. It's going to cause it to take even longer.
Oh, yeah. There's, the cost of labor is going to go up, the cost of materials, and it's already high
Right.
to begin with. And So yeah, it's that. And so to that point, it's like maybe they will just rebuild. It still might be cheaper and better to rebuild than go buy, especially if they have a lower interest rate locked in already.
Right. And the people that love where they live,
Right.
Palisades,
It's a
they're
great neighborhood.
you're on top of the ocean, so you can't beat that. So they might just say, you know what, we love the area, we're going to rebuild.
Yeah. Yeah. It'll be interesting to see. All right, Joe, was there anything else you wanted to talk about? As far as the mortgage industry, what's going on, even if it's specific to LA?
Well, yeah, specific to LA, I think, the next month is going to be challenging just because of the fires,
Yeah,
and insurance. So the insurance is the big deal. Getting insurance is going to be a real challenge. But I think after the dust settles and they have the fires contained or out, insurance companies are going to start to be a little more comfortable in jumping in. So that'll turn it around. But yeah, I think we'll have a little bit of a challenge over the next month with these fires.
yeah. Are you hearing, 'cause I heard through the grapevine that some lenders have stopped funding right now during the
Yes,
fires. Okay, so that's a thing. The guy wasn't BSing me.
but it's not all lenders.
Sure.
So just specific to rate and our policy, we're still lending, no restrictions on homes that are not near the fire areas. So if it's within a 10-mile distance of the actual fire, the fire line, then we
Okay.
have to pause and see what happens with the fire. But outside of the 10 miles, worst case scenario is if we had an appraisal that was already done, we have to send them back out to re-inspect just to make sure.
I've heard that.
But really, the many investors or lenders, we call them investors that we work with, I would say only about 10% have totally stopped funding. So that's a good thing.
Yeah. And really, anyone who enters escrow today, it's 30 days down the road before it funds.
Right.
So this is mostly people who are in escrow like right now, and they're like, crap.
Right.
That's who are really being affected. But really, to your point, it's just a delay. It's like, okay, it sucks, but we're gonna have to wait another week. It sucks. Like I have one under contract right now with my seller, and on the other side, the buyers came back and said, we need another week. And I told my sellers, like, we don't have a choice.
Right.
It just is what it is. We gotta work through this stuff.
Right. Yeah, we'll get through it.
Yeah, for sure. All right, Joe. Well, thank you so much for coming on. How can people find you?
Thanks for having me. Best is my cell, which is 818-687-6047. And legally, I have to disclose my NMLS license number, which is 255572.
All right. Very nice. Well, thank you so much, Joe. And thank you for everyone if you're watching this or listening to it. And maybe we'll have you back on later on in the year and we'll do kind of like a what's going on today.
That would be great. I appreciate you having me on. I really do.
Of course. Thank you so much. Thanks for tuning in to The Key to the City of Angels. I hope you found today's episode helpful as you navigate the world of Los Angeles real estate. Whether you're looking to buy your first home, expand your investment portfolio, or sell in this competitive market, I'm here to help you succeed. Let's connect. Visit my website or follow me on social media to learn more about how I can help you achieve your real estate goals. And if you're ready to take the next step, don't hesitate to reach out. I'd love to work with you. If you've enjoyed this episode, be sure to subscribe, leave a review, and share it with someone who might benefit. Together, let's unlock your potential and make your real estate dreams a reality.